following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are surviving these tumultuous markets and indeed profiting from them. At least we hope so. We hope our listeners out there are some of the more nuanced bunch out there who can profit from markets like these. My name is Mark Longo from theoptionsinsider.com, as well as the voice of many of these shows here on the old Options Insider Radio Network. And I am joined today by my stalwart companion, good old Don Schlesinger from the Volatility Exchange. Don, how are you today, sir?
I'm doing great, Mark. How about you?
Good, good. And I hear you survived the heat wave that is New Orleans.
I'm still here to tell the tale. That's about the best you can say about being in New Orleans with 97 degrees and 73% humidity, but I managed to survive.
You know, I think the hottest I've ever been in my life was when I was in New Orleans. It's just, I think actually a picture of me somewhere in that, and you could see me just melting away in the background somewhere. It was, I still have nightmares of that day.
Yep, me too.
And somehow I think it even got hotter at night. I don't understand how that happened, but it just, the heat is unrelenting and unyielding. It's just no escaping from it. It's amazing.
You know, when you walk out of your air-conditioned hotel room and within 5 seconds your glasses are completely fogged over as you step outside, that it's going to be a rough day.
Yeah, that's a sign that maybe you should go back inside. All right, Don, and if our listeners weren't confused enough by the names, now we're going to add a Dan to the mix today. Don and I have a special guest. He is Dan Keegan from the Chicago School of Trading. Dan, welcome to the program as well.
Thank you, Mark. Don, happy to be with you today. And obviously, there's been a little bit of volatility the last week, so we should have enough to discuss.
You noticed that, huh, Dan?
A little bit, yeah.
Mm-hmm. Dan has been gracious enough to join us for the entire show. So with that, we are going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, where we look back on the volatility and volatility action over the past few weeks. And since we haven't been on for a couple of weeks, there is a lot to discuss. We're going to kick things off with our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, what have you been watching for your volatility review, sir?
It's been crazy. We've seen some of the highest realized volatility. And certainly the last week, we've seen the highest realized volatility since 2008. It's been absolutely nuts. Between up until today, I think we had 4 straight 400-point moves, something like that. Just absolutely nutty.
Yeah, something in that range. We might have had a 100 or 200-point day in between there somewhere, but yeah, there were a number of 400-point swings in the broad market to digest, which from a volatility perspective has been intriguing to say the least.
No kidding. I mean, there's been just Europe going nuts, U.S. going nuts. If you like trading realized volatility, you like gamma scalping, you like time spreads, you like VIX, you like VIX ETNs, you like currencies, you like bonds. That's actually the one that blew me away the most, was the bonds. But, you are in a position, you had a lot of fun this last week.
Yeah, if you were savvy enough to do some gamma scalping here, then you've fared fairly well over the past few weeks. Even if you were short some vol, you probably could have made it up, at least a good portion of it, in gamma scalping. But of course, we don't look here at gamma. Vega is our purview on this show, and Vega, for many people, is personified in the old VIX. And the VIX has just been on fire of late, swinging wildly, some may say erratically, some may say in tune with the underlying, some may say marching to its own drummer. Where do you fall on that spectrum, sir?
I think VIX has been, if you look at how much the market was moving, VIX was underpriced for a couple days. Even at 48%, the VIX was underpriced. And now that it's Friday, we're up big. The VIX is now below 35%. We're only moving 1% today. Maybe we're starting to see a little sanity. But no, I don't think that. I think VIX did exactly what it should be doing. It said, hey, the market is crazy right now.
So, a big crazy sign for all the traders out there. And yes, the market we did gap up to those May 6th flash crash levels earlier this week when, of course, when the downgrade came through and the VIX cash gapped up to about 48. It's quickly drifted off from that level. As we were recording right now, the VIX cash is down exactly 4 handles to 35 even, and the futures are they still locked in contango?
Well, the futures are in, you mean backwardation? Yeah, but barely. VIX is now trading to August, trading at a half a point premium, but August is trading way over SEP. SEP is getting in line with October now. So I expect if we have one more day up, that everything sans August falls back into place. So that's my bet.
All right, and thank you for that, Mark. And now, of course, Dan, it has been just a crazy week, to say the least. I think crazy probably undersells it quite a bit. But nonetheless, I would think these are boom times for guys like you. So what was your take on what we saw over the past week in volatility in VIX?
It was wild. Obviously, if you entered the week with some bullets, in other words, if you were positive Vega and positive Gamma, it was like shooting fish in a barrel. It was just, you could do whatever you wanted to do. But the other odd thing is, even after the volatility exploded, you could get long the volatility and still make money. As insane as those premiums were, the time value that was embedded in the premiums, it would work for you, because the movement was so massive that, as long as you did that. Now, obviously, at some point, you can stick a pin in the balloon and it, empties out. But if somebody fresh at the beginning of the week sold a straddle and somebody who bought a straddle, the one buying it would have been better off. So far, at least.
And that's the type of thing, Dan, where it seems paradoxical, and we've discussed this, that there are two concepts about volatility, as you very well know, and they sometimes seem contradictory, and that is everybody talks about volatility being mean reverting, and when it gets stretched either way too high or low with comparison to historical levels, people talk about, well, it's going to go the other way and it's going to revert to the mean. But there's also that concept of persistence or clustering, which says that, high volatility, at least in the short term, very often begets even more high volatility, and vice versa on complacent, periods of time. So if you stayed long those straddles and long your exposure to volatility through Gamma and Vega, as you pointed out, you still had some wind in your sails and you did pretty well for the week.
Absolutely. In fact, I think the one day the VIX popped from 32 to 48, and then when it rallied, it dipped down again. But then when it crashed, the VIX went up, and then the next time it rallied, the VIX didn't go down as much because it was kind of waiting for the other shoe to drop. So it was, that's kind of an unusual thing. And like you said, it is mean reverting, but at what point does it start reverting to the mean is the key question.
Yeah, that's always the problem. People kind of say, well, it's stretched here, so it's going to go the other way. It doesn't always do it according to your personal timetable, so that makes it just a little bit harder.
Exactly. Timing is everything in trading volatility, market direction, everything.
But all right, and Dan, I liked what you mentioned there. I like that point about bullets. Spoken like a true floor trader, the object when we were on the floor was always to try to have some bullets whenever possible. It spoke to the discipline, too, of making sure that you kept your wings at the very least flat, and hopefully as you had some significant moves upside or downside, you would indeed get some of those ever so precious bullets, because these are the days where those bullets come in handy. Like you said, you drop to the downside, you have some bullets in your gun, you can shoot them at those very high premium levels and usually pocket quite a bit. It's also interesting to think that you could have gotten long even at those absurd levels and still done well. Obviously, if you're a little more savvy, you can scalp your gamma and improve your odds a little bit. But still, even I think for the less nuanced trader, still could have performed all right given the movements we're seeing right now. And of course, listeners, I should remind you that we're recording this on Friday, and as we're speaking, the S&P is up about 10 handles to 1182. The Dow is up 152 to 295. The Nasdaq up 19 handles to 2512, and the good old ever popular VIX Cash is down 3.83 points to 35.17, or down roughly 10% on the day. And of course, we do cover the broad spectrum of volatility and volatility products on this show, and that includes what's going on in the ever-popular world of the currencies. And Mr. Schlesinger, what did we see over the past week or so in the world of Euro-Vol?
Well, first, we'll back up a little bit. Since our last show, we actually had the 6th expiration of the 1-month cycle for the Euro vol contract, and it was interesting to note that the August settlement price on the expiration day of 12.13 was identical to the penny to the previous July settlement or expiration value. So you could look at that and say, gee, not much happened. But of course, we all know that there were 21 days in between or so, and there continued to be a great deal of volatility. So once again, for the 6th straight time, the 1-month vol contract actually experienced moves from low to high of greater than 20%. I think it was about 22% from trough to peak. So this continues to be an instrument where you can get some bang for your buck and some movement, especially in that 1-month product. Since then, we've begun a new realized volatility period, and we're trading the front month September contract, both in the 1 vol and the 3 vol. The 3 vol has been running for some time. That's the 3-month variety, and it has 69 days in the realized volatility period. There's about 49 down and 20 to go. So it'll be interesting to see the two of those trading side by side. We've gotten off to, interestingly enough, in these crazy and volatile times, very low volatility environment for the euro, at least over the first 4 days of this week as the new 1 vol for September started trading. But of course, there's plenty of time to go. So we'll keep an eye on that one.
I don't know, Don, you're starting to sound like a broken record with all these just crazy moves out there in this Euro-Vol contract. I'd imagine this is starting to pique some people's curiosity, and you're starting to see, I think, a little bit of uptick in interest and perhaps liquidity in these contracts as this thing is just moving like crazy. And, every trader you talk to these days is desperate for any sort of product that can offer him some decent premium and some decent volatility and some decent movement. So I'd imagine that's been playing to your favor of late.
Well, you know what we've mentioned on previous occasions is that here the product is volatility. So you tend to talk about the product itself. But if it were anything else, you'd be talking about, gee, what's the volatility of this instrument? So here we need to speak about the volatility of volatility, since the underlying is volatility itself. And as we've mentioned on more than one occasion, especially in the 1-month product, you do have tremendous volatility of that underlying, which is volatility itself. It's been for the past month about 87 or so for the euro, and I'm sure it's well over 100 for things like the S&P and equity in times like this. So you basically have a product that gives you the opportunity to trade and that moves around a great deal, and that's something that, as you've mentioned, has persisted over the entire life of this particular instrument that we introduced on the CME back in February.
All right, thank you for that, Don. And now, with our volatility review complete, we shall dive right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. This is, of course, the portion of the show where Don and I grab some poor soul from the world of options and drag him kicking and screaming onto the program to answer our questions, usually at the business end of some sort of nasty instrument. And today's victim is none other than Dan Keegan. He is the head options mentor and I believe co-founder as well. Dan, is that not correct? Of the Chicago School of Trading. And Dan, a second welcome to the show for you, sir.
Thank you. Happy to be here.
Yeah, we're doing things a little bit out of order today because we usually have the guests come on in this segment, but like you said, you were kind enough to want to dive into our volatility review as well, so you get multiple introductions on the program today, sir. And Dan, I'm sure many of our listeners are probably familiar with you as your various endeavors over the years, but for those of our listeners who are new either to you or to the Chicago School of Trading, give them a little bit of an overview of your background in the options business as well as what you guys do over there at the Chicago School of Trading.
Well, I first have to reveal how old I am. I started in the late 70s as a runner for a company called A.G. Becker, and I was a runner, phone clerk, floor broker for a few years there. And then Steve Fawcett, the world-renowned balloonist, the late Steve Fawcett, backed me. And since that, I've been a market maker on the CBOE for over 20 years.
Oh, so you were one of the Fawcett guys. You know, maybe perhaps you can answer a question I've heard rumors of, but I've never heard the truth of, perhaps, is that when you were one of Fawcett's backed guys, if you came back to the office with any long positions on any strikes, you were giving a stern talking to say the least.
That was actually totally false. It was probably about 40% of the people were extremely low. There were times when you'd have it kind of depended on where you were trading. So if you were in a pit where, he kind of left you alone if he thought you knew how to manage risks. So that was the notion everybody had, that you had to be short premium all the time, but that actually is a false. Well, I tended to be more of a back spreader than anything else.
Interesting, yeah. Like I said, I heard he was nothing but when in doubt, palms out, as many of the quote-unquote old-school CBOE hats were back in the day.
Right, exactly. And Steve, although he was wonderful businessman and everything, that his palms out type of thing made him blow out several times. And he was great at raising money. He was great at determining traders who knew how to manage risk. So he really wasn't a short-only type of
I didn't mean to derail your overview. By all means, please continue. I just thought that was an interesting tidbit to explore.
Oh, no, that is. No, that and it's funny. That's what everybody thinks. Oh, Fawcett, you must have been a huge premium seller. I wasn't, but not that, whether you're a premium seller or a buyer, it's kind of the same thing anyways, eventually, whether you're negative scalping or positive scalping, the gamma. You're kind of arriving at the same.
It's all scalping at the end of the day.
Exactly. With the Chicago School of Trading, what we're trying to recreate is kind of what I did when I was a runner, a phone clerk, and I would do extra stuff for market makers for free to learn this stuff. And now somebody at home, how do they learn that? They could read a book and they can go to some online class with 40 other people, but it's not the same as we give individual mentoring. And so it's bring them up to your level. It's almost like if I was hiring a clerk and going to back them, that's the kind of treatment they get. So they're going to be at a high level, whether they're retail putting on small positions or whether they want to go into get a career as a prop firm, kind of treated the same way, because the options don't know whether you're a professional or whether you're a retail person.
There's definitely a demand for that these days. I think that just speaks to why we're seeing so many mentors spring up in the options business these days. It's such a nuanced area of trading, and you're right. The people who didn't have the luxury that you and I did of coming up on the floor and having a firm spend money to train us and devote resources to train us, how do you get something equivalent in the retail world particularly? It's a difficult thing to do. So firms like yours certainly fill a definite need. And I'm surprised to hear, but I guess it doesn't really, when you think about it, doesn't truly surprise that you're actually receiving a lot of students, people who are looking to become professionals, professional market makers, professional traders as well.
Yeah, more the young guys, but then there's other people that are career changers. For instance, mortgage brokers. That business is kind of headed south, and there's a lot of them that are signing up with us now because they're familiar with numbers and they're kind of have that entrepreneurial mindset. And
so you do deal with a broad spectrum of students, retail, and some of these retail looking to be professional, I suppose you can call them. Interesting that mortgage brokers are diving into this. I hope some of their judgment in the options realm is better than what they showed in the mortgage space.
well, they weren't underwriting them; they were just getting them. That's
true. You can't lay all the blame at their feet. I just refinanced the other day, locked in a ridiculous rate, so I have to be thankful for them in that capacity. But let's talk a little bit about what you're seeing with these students who are coming through your door right now. A lot of them are usually, I would imagine, even if they're retail, they're leaning towards the higher end of the retail spectrum in terms of their willingness to commit assets and resources and time to learning options. And so they're a little bit of perhaps a different take than the traditional retail. But nonetheless, I'm curious, what are you hearing? What sort of things are you seeing from the retail you're working with right now? Are they heading for the exits right now with this kind of markets? Are they intrigued based on all the things you guys are teaching them that this is an opportunity? What are you seeing from them right now?
Right. Well, a lot of the retail traders are learning the hard way. Some of my students, even though I taught them this, and now they're believing it because it's real. That you need some of those little guys on the downside, because the way the vol skew is, you can afford to be net short calls. You can't really afford to be net short puts, because one occasion like this can wipe out 10 months of your earnings, unless you're really, really aggressive on your deltas, trying to convert some of those short puts into short calls.
Is that kind of the core focus? Well, I guess let's talk about what is the core focus then over at Chicago School of Trading. Are you teaching people to be net long premium, or are you net short premium, or are you net flat, perhaps delta neutral with long downside protection, and then looking to gamma scalp? What is the main focus over there?
There isn't a main focus in terms of, because you can't really teach a person to be a back spreader or to be a front spreader, because certain people are just, I think you're just born that way. It's almost like it's a stronger connection than your whatever your religion is or your political affiliation.
Are you saying you can't cure a degenerate premium seller? Is that what you're saying?
No, actually, I'm more of a premium buyer, but people that are premium sellers, it's just they feel comfortable doing that. And when they see somebody who's long premium losing money, they think they lost money because they're stupid. In the same way, a premium buyer sees somebody who's short premium losing money. Well, they're stupid because they're selling premium. So it's really, we don't teach either way. What we do is we teach them the basics, and then we teach them a ton of simulated trading where they manage both short premium and long premium. And the ones who aren't using real bullets now are getting a chance to see. So when they're ready to trade with the real money, fortunately, they've had this type of market experience, to see how it both benefits you if you're positive vega and hurts you if you're negative vega.
If you're saying you tend to be net long premium on the day, then I think my cohort here, Don, might have some words for you.
Right. Well, it depends on how you do. I mean, what you have to do is you got to really work real hard to make up for that losses. And it's kind of like when the VIX is down at 15. It might stay there for a while. You might not lose money, but it's kind of like keep your losses at a minimum, and then when your day in the sun comes, you milk it for everything you can. But on the other hand, if you're short premium, that's a great thing too. It's all about risk management either way. So that's kind of mainly what we teach people is be aware of what you have, be aware of the risk management, and be aware of what the volatility is, not just the overall volatility, but 1 month versus another, how that juxtaposes itself and how you might be able to take advantage of that.
Obviously, volatility is our core focus on this show, and I'm sure it's a significant component of what you do as well. Are you hearing a lot from new customers and clients coming your way? Are they, like we're seeing so often these days, are they obsessed with volatility, particularly the VIX? The VIX seems to personify volatility for a lot of the retail spectrum. Are they coming to you saying, teach me to trade VIX, teach me to trade VIX options, teach me to trade VIX futures? This is the product I want to dive into right now.
A lot of them say that, or they'll say, this is what I like to trade. And what we kind of teach them is, it doesn't really matter what you trade. And this is a true story. When I was first out as a market maker, one of the old timers, so this was back in the late 70s, the guy's an old timer. I doubt he's still around. He was trading a stock Weyerhaeuser, which is a lumber company. There was also a Weyerhaeuser shoe company. I mean, he knew when the dividend was, he knew all that stuff, but he thought it was a shoe company he was trading, not a lumber company. In other words, look at the numbers, don't look at the underlying product. Look at what the numbers tell you. Look at the vol skew, and you can trade anything. So it doesn't really need to be any particular product or equity or, commodity. Just look at the numbers.
Shoes, lumber, what's the difference, right?
Right, exactly. Mm-hmm.
Yeah, that actually was a bit of an education for me when I first came to the floor. I assumed, when I was talking to the firms and the guys that trained me, I assumed they all worked with analysts and had extensive positions in the underlying and knowledge of it. And they all said, no, this is not, we're not here to take extensive positions in the underlying. It's a much different game. That took me a little while to wrap my head around. And I think probably a lot of your clients were probably the same way.
100%.
You're still those fundamental analysts, huh? What for?
Yeah.
Right.
What are analysts for is probably a good topic as well.
They probably wouldn't want to be guests on this show. So.
No, we tend to take a dim view of analysts here on the Options Insider Radio Network and all of our affiliate programs. It's just not too much need for them. But you mentioned volatility and VIX, and we've had some interesting conversations in the past on VIX futures. And I know you guys in particular over at Chicago School of Trading have a big futures presence. I know one of your partners there, I believe it's Bill, was a long-standing futures guy. Are you seeing a lot of interest in and/or activity from your students? Are you teaching them to trade any of the VIX futures products, or is it primarily the options?
Primarily the options on the futures, the VIX futures. But it's, if you need the adjustment, you could use the future. But it's when it gets down, when the VIX is at a very low level, you could, for instance, sell a VIX put vertical and buy an S&P put. Maybe 5% out of the money, and you're hardly taking any money out of your pocket. And it's almost like it's a third down where, you're dropping back to pass, and you see a flag was thrown, the other team was offside, and you can throw it downfield. That's one of those type positions that you can have. Whereas now it's highly speculative right now, whatever you're doing with the VIX.
Now, you mentioned before the commodities. They are quite hot right now. I mean, if I can't recall any other time right now where I'm seeing so much interest in our email and in our forums about things like metals and things like corn. I never thought corn would be a sexy product, but c'est la vie.
Certainly moves around a lot, so.
Exactly. It moves quite a bit, and that tends to draw people's attention. Are you starting to focus more on what's going on in the corn and the metals and some of these more commodity-type products and work with your students to understand the vol skews out there and how those products trade?
Yeah, well, obviously with the ags, it's you kind of flip-flop in the skew, and it's people can kind of see it intellectually, but if you're used to trading the equity skew, even though intellectually the other one is opposite, or at least it is a good percentage of the time, that it's kind of hard to pull the trigger on it, if you know what I mean.
Yeah, if you're a covered call writer or maybe even a put seller, whatever the case may be, and you come in from the equity side and you come into the commodity world looking to apply those same strategies, it takes a little bit, I think, of adjustment in your head because they perform quite differently out in the world of corn and metals.
Yeah, but it's once again, if you can discipline yourself and realize how they trade, which direction is the more dangerous one, then you can just set up your position that way and work. As long as there's movement, either way, whether you're short or long premium, there's ways to make money. And I know the silver was a terrific trade for a while, and then it kind of took the big dump, and it kind of stabilized, but it's been moving around a lot. And of course, gold is, everybody wants in on gold.
Talk about crazy skew. Silver for a while there had probably some of the craziest skew I've ever seen. And obviously it is, like as you said, the inverse of what we see in the equity world. So everyone is afraid of a crash to the upside. So the put premium that we see in the equity world is a call premium in things like silver. And we saw a few months ago some premium levels for silver and out in the big futures options as well as in the ETF options like SLV, just extreme levels of fear to the upside. And people were, I know a lot of people coming to our site and listening to our shows were having a field day hitting bids on a lot of these absurdly 30, 40, 50% out of the money calls that were front month and getting paid absurdly well to do it. So that was probably a bad introduction for a lot of people who are in that space. But nonetheless, it lured a lot of people to the dark side in the world of the commodity options.
Yeah, it's basically all you have to. It kind of makes sense that commodity options and equity options would have different skew because a stock could go to zero. Corn's never going to go to zero. You know what I mean? And when there's a shortage of corn, it makes a huge move up. So that, the big move is going to be to the upside. And, just like with stocks, even though it might be going up more days than it goes down, the huge moves obviously are to the downside. So the skews are set up that way for a reason. But, I'd say gold and silver are the biggest that my students are interested in.
Yeah, they seem to have a very strong retail crossover, both of those metals. But Dan, we've discussed a number of times on this program as well, concepts like the traditional way I think you and I were taught to trade volatility, which is a delta neutral type approach where you would come in, maybe trade a straddle, trade a long premium position, whatever the case may be, and hedge it with the underlying to lock in a quote unquote pure volatility position. That's the way a lot of people did it back in the day. That's the way a lot of people still do it today. And now you have, guys coming along like Volex who can offer a bit of an alternative like a realized vol product currently in the euro, but expanding in the future. And I'm curious, you said you don't really take a one-size-fits-all approach to your mentoring, but have you traditionally relied on that delta neutral type approach with your students where they can come in and trade volatility in that sense?
I initially want to teach them that just to show them, trying to get the thing out of your head of being, where's the stock going to go? That you can make money without having an idea where the stock is going to go. So you take the delta neutral approach initially to get them trained in the head, and then they can lean their deltas a certain way. And obviously, if you're positive vega in an equity, you're going to need to lean your deltas a little bit longer if you want to be truly neutral as to how you're trading, because if it runs to the upside, you're positive vega, and the implied volatility gets crushed, then you're not really neutral, you're short. So you have to accumulate some extra deltas in order to compensate for the decrease in the implied volatility should you be positive vega.
Yeah, that kind of underlines the numerous issues and tweaks that are necessary whenever you're taking a delta neutral type approach. I mean, it's sold, I think, to a lot of us as a way to capture pure volatility, but quite often you need to take a number of little tweaks and a little nuances to it in order to really make it perform the way you want it to.
What's kind of interesting there, Dan, and you bring up an interesting point, and there's kind of two sides to it. And that is that when you're trading day to day and you're marked to the market, the comment that you just made makes perfectly good sense because your options get marked to an implied volatility. And obviously with the equity skew, at least, as you're going up, the implieds are going down and vice versa. But it would also kind of be interesting that at the very points that you are trading the options themselves, or sometimes you get delta neutral using the futures rather than the options, you're actually trying to capture, if you're in it for the duration, the realized volatility of the underlying. So you get that kind of a contradictory concept there where when you're making your adjustments, you're probably forced to do it with options that obviously have an implied volatility that's moving around with the stock level. But if you're in it for the duration, then what you hope to achieve when the position expires is to have captured the realized volatility of the underlying, which would then be irrespective of the level where the underlying has moved. So it's kind of two things that you're trying to do at once, and they're not always the same objective.
That's right. It is. That's right. I mean, that can cost you money at times doing it, though. Also, it can make you money as well, depending on how you manage it, and also just plain luck as well. But no, the realized volatility product is a great product, and that kind of takes that out of the equation.
It kind of just simplifies the process for, a lot of people who have been using these delta neutral type approaches for years and have been doing things like you said, like having to lean long deltas to the upside and make sure to scalp your gamma accordingly. And as we all know, gamma scalping is an inefficient art at best, and it's usually a highly subjective one. Where to work your scalps, how to make sure you get them off at the right levels. It's a difficult process. One, I'm sure you probably spend a lot of time working with your students on as well, Dan.
Yeah, it's definitely a seat of the pants type of strategy, and it's kind of what I was trying to teach them this week is, you want to be delta neutral, but if you see a train going 400 miles an hour, you don't have to stand in the middle of the tracks to try to wave it down. So you get to positive 100 deltas, wait until it gets to 700 or 800, the way it's moving so fast. So, and once again, that's a judgment call, which is, there's no way to teach somebody how to make money. Here's a formula, go make money. Ultimately, it rests on the judgment calls that the individual trader makes. But you just have to prepare them that they know as much as they can know for that moment. So in other words, trading is an art, not a science, but if you don't know the science, you're not going to be very good at the art.
Yeah, I certainly agree with that, and I do a lot of lecturing with new people coming into the industry, and we talk about delta neutral trading both from the short and the long side, and you explain about the follow-ups and when you adjust the position or even what the concept of what that would be, and they're always looking for that kind of guidance. Well, how long do I let the deltas run before I do something? I say that's not something that you look up on page so-and-so of a particular book or a manual. And, they're not happy with that because they want definitive answers, but it's exactly what you just said. If you can't develop a feel for that kind of thing, you're probably not going to be very good at it. And even if you're terrific at it, your feel isn't right all the time. And so it's a humbling experience. But I agree with your comment. You do have to know the science. You do have to know all the numbers. You have to have all of that as a background. But it's like in math, what they say is a necessary but not sufficient condition. So after you know all of that, then you got to sit there and watch markets for days and weeks and months and years on end and try to develop that feel and that's the art part that comes along.
Yep, and you can be trading for 30 years and you still haven't perfected it. So and you're right, it's humbling when you're wrong, but it's got to keep going.
And it's like anything else. You can't ever hope to be right all the time. You just try to develop that art to the point where you're right more than you're wrong, or even if it's 50-50, when you're right, you make more money than you lose. So whatever the approach, it's something that develops. But if you think you're going to be right all the time, you're in the wrong industry.
Absolutely, yeah. It's not an industry for perfectionists, that's for sure.
That's why I've always called gamma scalping a black art at best. It's even when you're doing it right, you're still upset most of the time.
That's why options traders are the biggest whiners in the world. Even if they've made money, there's 20 other things they could have done that would have made the money.
Exactly. You left a few ticks on the table here or there or something, and it's going to haunt you. But I'm glad, Dan, to hear that you are working with your students and teaching them gamma scalping, because for me, that's always been one of the things that separated the pros from retail, is that particular technique. And quite frankly, if you don't understand it and know how to do it, it makes it extremely difficult to trade long premium effectively and profitably. I mean, you see all these, for years, you saw these late night infomercials coming out there about make money in any market direction using options. And, they were pitching things like buy straddles. And there was never any mention in any of these places that you might have to scalp some gamma to make that trade pay off. And so a lot of retail comes into these types of trades thinking, hey, it's fantastic. It's a free lunch. I can make money in any market condition. And they're not versed or skilled in some of the more subtle arts that are required to make that actually pay out. So I'm glad that guys like you are out there teaching them these things to make them more effective, because if they're going to come out and just buy straddles and let the chips fall where they may, they're better off doing other things.
Yeah, absolutely. And it kind of works the other way too. Like, even if you're short premium, even though most of the time you'd be making money, like, just sell these iron condors and, you'll make X amount of money. But as we've seen in times like this, it doesn't always, you can get blown out, not blown out because it's a vertical, but you can lose money if you're not ready and able to adjust on those positions as well, even if it's from the short side. Overall, you're not going to make money. You have to be on the ball and ready to make adjustments. That's what I always tell my new students is 90% of your money is going to come from the adjustments you make, not the initial position that you establish.
Exactly. Like Don mentioned, and like I've said a number of times on this show and others, there's no book to teach you really those parts, the adjustments. Every education book out there on options shows you when you initiate the position and how it looks at expiration. But 99.9% of the game is in between those 2 points, and there is very precious little at all to really instruct you on what to do there. So I'm glad, like I said, there are guys like you out there doing that, and I want to thank you for coming on our Volatility Viewpoint today. And since you are kind enough to stay with us for the entire show, we're going to roll right into our crystal ball segment.
And now we take a look at the crystal ball.
And welcome to our crystal ball segment. This is, of course, the segment where Don and I, and sometimes a guest, speculate wildly on the future of the market. No, actually, we speculate, perhaps a little bit less than wildly, but speculate nonetheless on what we're expecting to see in the coming sessions. And we're going to kick things off with our volatility pit reporter, good old Mr. Seabass from optionpit.com. And Mr. Sebastian, what are you seeing in your crystal ball for the coming week?
I think we got one more push in us. So my thought is, we're going to sell off the rest of the day today, maybe Monday, maybe Tuesday. We're going to get a piece of news next week, pushes us back over 40 in the VIX, probably for settlement on Wednesday. That would make the most sense, because that's how VIX operates. And then maybe smooth sailing from there. There's got to be one more push here. I don't buy all as well. The behavior of VIX yesterday, where the market was up 400 and VIX red down, but vol was actually up. I just I'm not a big believer that the VIX belongs below 30 yet, and I don't see it happening without at least one more little push back here. So keep an eye on the S&Ps. I think if we can get, from here, we got a shot at running up to 1250. If in fact I'm wrong, but otherwise we're going to test 1120 again.
All right, and thank you for that, Mr. Sebastian. And of course, we are joined still by Mr. Dan Keegan. He is the Grand Poobah, the Viceroy, even, if you will, over at Chicago School of Trading. And Dan, what are you counseling your students right now? I mean, obviously, we're in a period of serious flux, serious volatility. We saw near flash crash levels of the VIX earlier this week. We've settled off a little bit since then, but obviously there's potential for both upside and significant downside in volatility to come. How are you counseling them to position going forward? Are they looking for maybe preparing for another upside pop? Are they preparing for volatility to come off a little bit? What are you counseling them?
Basically, here's how I counsel them. Whether they're doing a lot of their simulated trading and all that, and they say, well, I've made a lot of money the last couple of weeks. I said, well, why'd you make the money? And then they usually can pull it out of them. Well, I was positive Vega. Okay. So was I just lucky? Well, anybody can make money. Can you keep the money you made? So it's at some point you want to take at least some of that off, even though it's been, as Don said earlier, it's been great to trade. Even with the high premiums, you can make money scalping back and forth. But at some point you want to take some of it off, and you have to decide which month you want to do it. If you do it the further out, it might be a lower implied volatility, but it's an actual greater dollar amount. So when it does start to melt, it'll be a bigger meltdown than the closer, higher volatility. So it's kind of that. Basically, you can even sell premium now if you want to, but you have to be prepared to be extremely aggressive, and at some point throw in the safety valves. As to how far down the line you want to do it, that's up to you.
So there's no specific positioning then? You're not saying come out and maybe get short time spreads to get short vol here and long some gamma, nothing like that?
No, it's more like if this is what your opinion is, that's what you can do. But I don't ever say this is what's going to happen in the future, because you know what, I don't know. I mean, obviously the implied volatilities are going to peel off. If you even look at the VIX futures, they're steadily lower each month, as it was the opposite for months. So obviously it's gonna come in, but at what point will it come in? I don't know. But it's not a bad time to be short Vega, to be negative Vega right now. You just have to be extremely aggressive and possibly even wind up getting one of those weird positions where you're positive gamma and negative Vega.
I'm glad you brought that up. Just make a quick point, Dan, about the VIX futures and how you have what in the commodities world is called backwardation now rather than contango, because for so long, where vol was at fairly low levels, people were looking at further out, the far months and saying, well, yeah, that's what happens. They're just higher as you go farther out. That's the term structure of volatility. And that was always a pet peeve of mine and bothered me, because the implication was that there's some particular reason why, as you go farther out, you should just keep making a forecast of higher volatility. And it just doesn't make any sense. And so now you see clearly and graphically when the present environment is an extremely high regime of volatility, it just doesn't make sense to predict going farther out, 3 months, 4 months, that kind of a level is going to persist. And so you see the opposite, which is to say we might have these levels of volatility for a month, but it's just not going to happen for 4 months. And so you see the opposite. So it's always kind of been a pet peeve of mine when people make the blanket statement, oh yeah, that's the way volatility works. The farther out you go, the higher people are predicting it will be. It's just not the case.
No, when the VIX was bouncing between 15 and 19 for months and months, that was the case. But now that it made the pop, it's the opposite. Instead of climbing up a mountain, you're going down a ski slope. So,
and all this talk of VIX, if there was one refrain I heard over and over again over the past week and a half or so, to the point where I grew quite suspicious of it, it was everyone and their mother getting short the VIX ahead of last Tuesday, which was, of course, the debt debate timeline there. And so everyone thought no matter what would happen, the warring parties would come together at the last minute. There would be some sort of deal and the VIX would come off commensurately. And we saw a significant amount of people positioning very heavily to the downside in VIX. And I've always learned whenever I hear it from all sides of the market to take a position that's definitely not the position you want to take. And I backed off, as I think some other people did. And sure enough, we've seen unfold a crazy series of things since that date that have sent the VIX skyward. If I had this show 2 weeks ago, I would have said everyone's leaning to the short VIX. Right now, I don't think there is a consensus, and that I think is probably a safer place to be right now than everyone leaning to one way or the other right now in the old VIX.
You got suspicious when your barber told you to sell the VIX, right, Mark?
Exactly. When you're taking the cab home, he's like, hey, by the way, are you short VIX? That's when you're saying, wait a minute, this has reached saturation.
That is what it was like. What really was. It was expecting, well, they got the debt deal and everything's over with, and lo and behold, the market craps out anyways, and then the S&P downgrade. But
the only other time I can recall everyone being on the same page so often in a trade that worked out so spectacularly poorly was when everyone and their mother said to short the Enron 20 puts. This was free money.
Right.
Look how well that one worked out as well. But of course, we do cover and prognosticate on the broad spectrum of volatility here, and that includes the world of Euro vol. And Don, I don't know if you can prognosticate given the crazy movements we've been seeing out there in that vol contract, but nonetheless, you will give it a shot.
I probably can't, and especially with plenty of news coming from Europe as well, and from the French banks and from abroad, it certainly bodes well for continuing volatility with the euro and currency. And I mentioned earlier that we had gotten off to a very slow and low realized volatility for this week in the euro starting out, but with about 3 weeks to go in the present contract, I certainly would be foolish to forecast anything but more interesting times. So vol contract settled last night at 1260, off a little bit today. We've got the forecast from Robin Engel and his Volatility Institute group using his proprietary Garch models, and there he's forecasting something down into the 10 handle. So that'll be interesting to see how that plays out. Current contract trading significantly higher than an actual Garch prediction for what the 1 month September will settle at. So we'll keep an eye on that.
Yeah, and whatever we end up prognosticating right now in this segment, there's one thing that is an inescapable truth. That is, given everything we've seen over the past few weeks in the market, there is quite literal weekend risk right now in the market. We talk about it always as a very ethereal concept. Oh, there's weekend risk. But as we saw last Friday and even in previous weeks, anything could happen going into the weekend, and you should be prepared for that, especially right now. So as we discussed earlier in the show, might be a good time to have some long bullets, as they say, long premium, at least to the downside in the equity world, and perhaps preparing for another potential upside spike in the VIX in the near term, even though you may be considering the VIX will come off in the long term. So yes, prepare yourself accordingly, and don't let what caught us last weekend catch you again this weekend. And with that, that's going to do it for this episode of Volatility Views. I want to thank our guest, Dan Keegan from the Chicago School of Trading. And Dan, is there anything else you'd like to leave our listeners with before we go?
Just be prepared and be alert for everything you're doing. That's all you can do is, try not to be married to your opinions.
Sage advice, as always. And are there any interesting classes or promos you have coming up at the Chicago School of Trading you want to make our listeners aware of?
We don't have anything in particular. Just go to thechicagoschooloftrading.com. Check it out. You can call 312-242-1858, and we could tell you what we have to offer.
And listeners, if you want to contribute a new microphone to Dan, feel free, so we can bring him on again the next show, and it won't your head won't be pounding as much in the next episode. And of course, my good partner in crime, I want to thank good old Don Schlesinger from Volex for coming on the show as well. And Don, before we go, is there anything fun or interesting or new coming up over at volex.us?
Well, we continue to refine the website, put up new articles, new research, and some of the staple features that are there are the type of things that we've mentioned in the past regarding the volatility cones, the predictions of future volatility, the pages with information about historical volatility and vol of vol. So a wealth of information there. We'll continue to refine the site as we go along. One final announcement, and that is we have another guest scheduled for next Friday. His name is Ewan Sinclair, and he's the author of a book on volatility trading. I think listeners will find his opinions very interesting. So we're looking forward to next week's show as well. And Dan, let me add my thanks to Mark for coming on. I enjoyed your viewpoints, and you're welcome back at any time.
Okay, and I'll try to get a little steadier and stop gesticulating so much by myself.
You get so excited over there. It overwhelms your equipment.
Right.
All right, and that is going to do it for this episode. I want to remind our listeners that they want to get in touch with us or send us your feedback to surf on over to theoptionsinsider.com and then scroll on down to the Volatility Views forum where you can post your questions for myself or Don. We didn't have a chance to get to the mailbag this week, but we'll open it up again in future episodes. And I want to thank you all for downloading and streaming and subscribing to this program and making it such a hit. We're climbing up the charts like wildfire there, Don. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.